Hey everyone, welcome to today's event. We'll get started here in just a few more seconds as folks are joining. Thanks everyone for being on time. We've still got some more folks joining. Thanks everyone again for being on time. We'll give it a few more seconds here for folks to join on in. Thanks everyone again for joining us today. Alrighty, we got a packed agenda today, so I'm going to jump right in. Thanks again everyone for joining. Today's event is all around risk management for financial institutions and really looking at 2024 and beyond. And what are the things you can do to ultimately improve your risk management at your organization? So, a couple introductions before we get started. My name is Taylor Wells. I'm on the marketing team here at Rivial. I'm joined with Lucas Hathaway and Randy Lindberg. Lucas, would you mind introducing yourself real quick?
Yeah, absolutely. Lucas Hathaway. I'm the Chief Revenue Officer here at Rivial, but I've been working with Randy for almost 10 years now and have worn many hats over the years from consulting to being our operations manager to now helping our clients grow.
Thanks, Lucas. Randy, you mind introducing yourself?
Sure, absolutely. And as you say that, Lucas, it amazes me that you put up with me this long, but it has been nearly 10 years. So yeah, my name is Randy Lindberg, founder and CEO of Rivial. I started the company in 2010 to do better risk assessments and provide better security services. I think we've accomplished that, and we're still accomplishing that. And as far as what I do on a day-to-day basis, it changes from taking out the garbage to sweeping the floors, and that's actually true because we're all remote. We're a remote company, but at any rate, glad to be on. Glad you folks joined us, and I'm excited to get into some questions.
Thanks, Randy. And on that note, yeah, being remote is fun because the people that interrupt you are not your coworkers, it's your family. And I always think it's a special benefit, challenge, and yet benefit. Well, right
Yes,
on.
indeed.
I love it. Thanks for the introductions, both of you. Looking forward to our conversation today. So, before we get into some technical stuff, I just want to kind of highlight the agenda. We're going to be going through kind of 5 different sections. We're going to be talking about risk tolerance, making risk-based decisions, quantifying risks, determining ROI of your security program, and how to increase trust with your board of directors. We will be answering questions throughout the event, so please throw them in the Q&A. Randy and Lucas love a curveball question, so definitely throw it out for them, and we'd love to answer your specific questions if we can. For something that's super complex or nuanced, and we can't answer it live, we'll definitely follow up with you, or you can follow up with us after the event as well. We can love to have a one-on-one conversation. We will be recording the event as well, so if you want to share it with your team, or if you miss something, you want to rewatch it, we'll be sending that out after the event. We also do these monthly as well. So join us next month. You can also go to our website, check out our catalog of amazing guests we've had on, different workshops we've done all around cybersecurity for financial institutions, banks, and credit unions. So let's jump right into the topics. Okay, our first kind of area is risk tolerance. So one of our first questions here is, why is it important to set an appropriate risk tolerance? Randy, you want to take a stab at that question?
Sure, absolutely. So I think, well, for starters, your examiner, if you're at a financial institution, might ask, right? And I know that it kind of ebbs and flows, right? The risk tolerance or risk appetite is another way to say that. So it's not like vendor management that has become important to examiners and has stayed there. It seems to come and go. Like 15 years ago, risk appetite was very important. Maybe 10 years ago, it wasn't so much. And so it has fluctuated, but it's very likely that your examiner, particularly as they learn more about risk assessment, right? There is a big push, particularly on the credit union side, for the examiners themselves to learn more about risk management, and having that risk tolerance or again risk appetite, different way to say it, is very important just from an exam standpoint. From an actual security standpoint, also very important because it gives you a yardstick to measure your risk against. So if you're going out and you're doing a risk assessment and whatever the results are, if you don't have something to go back and compare that to, it's hard to really make those risk-based decisions, because even when you do a risk assessment, you can't solve everything, right? Your security program, you're gonna run out of money and time and go out of business trying to solve everything. And so to have that yardstick there to say, what is our organization, what is their risk appetite? What are they willing to accept from a loss or risk tolerance? Then do the risk assessment, and then you have something to go back to compare those results to make better decisions.
Thanks, Randy. Lucas, any color or nuance you'd like to add there?
I don't believe so. Randy really covered the two things I had. When we're walking through this with clients, I call it a measuring stick, really that threshold. And when it is clearly defined, it makes it easy for those decisions. Is your risk above that threshold? If so, by how much? And can you make an exception for that, or do you need to mitigate it or do something about it? So that's really where we see it come into play. And with organizations we work with, when we see it is clearly defined, they have a far easier time making decisions because everyone's on the same page, everyone's in agreement on that threshold. And so, if everything's below it, great. Everyone's happy, no questions asked. If there's items above it, that's where those decisions become a lot clearer.
Thanks, Lucas. That's great. And I see a couple more folks have joined the event. Once again, if you have questions around these different risk management topics, please submit them in the Q&A or chat. We'll try to answer them throughout the event. Thanks again for everyone for joining us. So we'll move on to the next kind of question under risk tolerance. And I'll throw this one at you, Lucas. Is there a methodology or rule of thumb when developing an organization's risk tolerance?
Yeah, it's a great question. And the way we often see it when we start working with an organization is it's often pretty vague. Like we have a low medium risk tolerance as an organization. And the issue with that, at least it's a start. So there is something which is really good. The issue with that is it's really hard to define. It's hard to define what is low medium risk. And so obviously today, a little biased, we're going to be talking a lot about quantifying risk and the benefits of that. But the methodology we take is really assigning dollar values to that risk tolerance at different probabilities. So if I were to say, so like when we meet with an organization, we like to sit down and go, okay, if I say you have a 75% chance of loss this year, how much money, how much loss could the organization be willing to accept? Maybe that's $100,000, maybe it's $10,000, and it varies greatly depending on the size of the organization, as well as how risk averse or risky that they are. So we do see a pretty big range there, but we walk through at different probabilities, all the way down to 1%. So if you have a 1% chance, worst case scenario, wouldn't cripple the business though, how much could you accept? Is that $1 million? Is it 2 million? Maybe it's small organizations, it might be 100,000. And so having that conversation with the different folks to really help scope that in, we found works really well, especially with the business people that we work with. CFOs, they don't speak cybersecurity as much, so using that in dollar figures and probabilities, that their financial brain understands that a lot better, and it helps have that conversation and get everyone in agreement on that risk tolerance.
Super great. Thanks, Lucas. Randy, any additional thoughts there?
Yeah, I would say, first of all, great explanation, Lucas. I think that probably went a long way for everybody watching the webinar. And that method can seem a little bit intimidating at first. If you're the person who's going to be asking the questions of executives or the board, you might think, oh my gosh, they're not going to answer this, they're going to hate me. It's actually a very natural way to think about risk. So it does flow pretty well as long as you ask the questions the right way and consistently. And also, if you want more details about that process, we actually adopted it from the book. I think it was first published in 2016. It's called How to Measure Anything in Cybersecurity Risk. I don't recall the author's name. We don't get a kickback or anything. It's just a very good book. So we started looking at Monte Carlo analysis and quantification back in 2008. I was actually in an MBA finance class, and we looked at how quantification was used. Fast forward to 2016, when that book came out, I dug through that, and the questions, the way that he asked the questions, or the authors, I should say, and plotted them on a curve. Very slick way of doing it, very easy. So again, if you want more details on how to ask those questions and what to do with the results, that book, I think it's maybe $30. It was, again, originally published in, I think 2016. And I want to say last April, a new edition came out. So grab that one. It's well worth reading. I'll say that.
Thanks, Randy. That's great. Yeah, and just as an anecdotal story from my end, I used to work for a managed security provider, and we were mostly selling to C-suite that were non-technical folks, right? So they had maybe an IT folks, but we were selling ultimately to the C-suite and or board of directors. And quantifying cybersecurity or security in general was always the hardest part, right? And compliance, insurance requirements, cybersecurity insurance requirements, those were all much more easy to kind of tie back to like an outcome, right? Or an ROI. But I think one of the coolest parts about, Reveal's mission and products and thought leadership is how do we actually quantify cybersecurity? Because it's like the most nebulous thing to quantify, especially for folks that are not in cybersecurity, right? Your board of directors, your
Sure.
CEO, your CFO. So really cool stuff. And I'm excited to get through these other topics and talk more about it. Let's move on to the next question here. What types of tools and techniques can help in deriving your risk tolerance? Randy, let's start with you.
Okay, yeah, I'll take that one. I would say, again, the way you ask the questions, it's still a very natural way of thinking about risk. But one thing you can do is compare IT risk or cybersecurity risk to other parts of the business or other areas within the business. So, for example, people regularly are making decisions around, if we spend X dollars to make Y dollars, right? You can take that thought process and those dollar amounts kind of to scale and compare that to risk, right? So you're risking, which is potentially spending X dollars, right? That's your risk, to make Y dollars by running your IT systems. So if you're running your IT systems, they introduce risk, right? The only reason we're doing that as companies is to make more money or be more efficient or gain more clients or whatever it is. But ultimately, it's about the dollars. And so what you're risking to run those systems can be, again, compared to other parts of the business in terms of again, spending X to make Y. And so I would think about it in terms of, how much the company or the institution makes or saves by using the technology that introduces that risk. One other, I don't know if it's a technique, but you could also ask the CFO. They have a pretty good handle on dollars and scale and what's important and what's not.
Helpful. Lucas, any additional thoughts there?
I'll just add a quick kind of story that kind of ties into that nicely as far as looking at risk in other areas of the business and comparing it. Is I was working with a larger credit union, doing a workshop with their executive team, helping them set this risk tolerance, and everyone was struggling. Some of the team was like, no, we can accept way more. Some was going, no, we're less, and they were just kind of stuck in this middle ground. And one thing that really helped, kind of to Randy's point, is comparing it to other areas of the business was they considered like their fraud loss from the year before. Financial institutions, there's money lost from fraud every year. And so by looking at that, they went, oh, yeah, that number was way higher than we were anticipating. And the business didn't shut down. The world didn't end. They lost that amount of money last year. They were able to continue on business. And so by comparing it to their fraud losses the year prior, it gave them a lot better starting point of, okay, so that amount is acceptable. So maybe that's kind of our middle ground, or 50%, what we're 50% probability of what we're comfortable losing, and then could work backwards from there down to kind of the worst case scenario. So I think that piece helps a lot as far as just comparing to other areas of the business, looking at other potential losses the organization might have every year. And if those are acceptable, then that helps you start to scope in what might be acceptable on the cyber risk side as well.
Fascinating. That's super interesting to kind of tie it. And once again, especially for folks that are outside of the information security realm, tying it to things that are relevant to their role and or position, and then driving it back ultimately to dollars. That's great. Lucas, I'll have you start with this next question here. What considerations should be taken into account when defining a risk tolerance?
Yeah, good question. I would say one area that gets brought up when we are setting these with clients is always cyber insurance. They're starting to set this risk tolerance, and they go, oh, but we have cyber insurance, so we can accept X more amount of dollars. And I always caution people and tell them, recommend that they take cyber insurance out of it. So when you're setting that risk tolerance, pretend you don't currently have that cyber insurance. The reason being is cyber insurance is a risk transference strategy. And so when you're looking at your results, when you're looking at, you compare your risk assessment results back to that risk tolerance, that's when you want to take that cyber insurance into account, because you're still paying for that cyber insurance. It's an expense. And so this also can help you scope in how much cyber insurance you need. By looking at your risk, is it below that risk tolerance? Is it above it? If so, by how much? And maybe your cyber insurance covers that amount above risk tolerance. So you can comfortably accept it with what you're currently spending on, the amount of risk you're transferring to your cyber insurance. So I know that's kind of a consideration not to take into account, but I always recommend leaving out the cyber insurance piece when setting the initial risk tolerance. And then, of course, thinking about it when you're making those business decisions based on the risk results.
Thanks, Lucas. Randy, any additional thoughts there?
Yeah, a couple smaller items. I think that's a significant one. I think because a lot of people get into that trap of just saying, "Oh no, it's fine, it's fine." Well, it's not. You have to measure the risk and then treat it, which might be with insurance. You have to transfer that risk. But I would say a couple things. One is the organization. Most organizations have usually it's a number or potentially a range of what is material versus not material. What I mean by that is, for example, any company that has to report publicly traded company, if something happens that materially impacts their books, they have to report that. And so that number, the bigger the company, the higher the number. But whether it's material or not, that obviously we want more of a range in terms of the loss tolerance. But that number can help at least set the stage. What is material? What do we care about versus what do we not care about? Because it's too small a number to really even worry about. It's not going to change our books, so to speak. And of course, the CFO is going to know. So the CFO very helpful in this exercise. I would say the second consideration is the industry. I know a lot of the folks on our financial institutions, that's who we work with most. But just reaching back to my past, and the timeline is, there's some context there as well. But when I was in the Air Force way back when, I'm not going to date myself and say it was the late 90s, the Air Force accepted no risk. Right? We didn't have all of the security we do today. It was very rudimentary back then. But the military just accepted no risk. That's how they operated. A few years after that, I went to a Fortune 50 retail company, and it was Albertsons. There's no secret this was almost 20 years ago. But they didn't care about risk. I'm not sure they could even spell risk, because it was all about just go get the job done. My first meeting with the CTO, I was the information security manager, at 30 years old, Fortune 50 company. Don't ask me how I got there, but my first meeting with the CTO, he said, "I don't like security because it gets in my way." I said, "Okay, so your loss tolerance curve is basically at the top." And so he accepted everything. He didn't want security. Wasn't a great job to have, but thankfully I do know from friends that they've come a long way. But I think the industry, your organization, and just the people who run it are also a consideration, right? You're not, as a security person, we tend to think that everybody should care about security as much as we do, and that's a recipe for frustration. And so just considering, again, maybe not the industry specifically, but just your organization and the people that are making those decisions, view it from their perspective, and your life, I think, will be a little easier.
That's great, Randy. And I appreciate that's a great just life lesson almost of like, how do we almost have empathy, right, for the rest of the org, and understanding the other folks that are involved in this decision making, and put it from their perspective. Because once again, If you want to get movement around change, right? Cybersecurity change, risk management change, whatever, you have to get people's alignment and buy-in and come from their perspective, and there has to be compromise and hearing everyone out and negotiation, et cetera, especially when you're trying to spend more money, right? Or bring on more tools or grow your security stack. So really appreciate that. We actually do have a question that came through from Matthew, and I'll read it out here. Should a business have one risk appetite statement for the overall organization, or should there be multiple risk assessment statements for each significant business line or function? And I'll give you guys a few seconds here to think about that. And whoever wants to answer it, feel free to jump in.
I'll jump in, and we might differ on this. I don't know. We've not talked about this a lot, but I have given it some thought several times throughout, building the model and whatnot. I would say that ideally, in an ideal world where we all have plenty of time and money to do things, yes, there would be multiple risk appetite statements, because if you think about it, the loss that you would be willing to accept running, and I'll focus on systems for a second here, running your core system at a financial institution, it's going to be very different than a branch kiosk, right? Just the scale is different. The risk appetite statement, again, ideally would be different, perhaps for different business units. Having said that, what we see and what we're working toward in this industry is just getting to a risk appetite statement that makes sense. And so there's the ideal, and then there's the reality. If you can get to a point where you have multiple risk appetite statements, absolutely, I would do that in a heartbeat. Just know that it's, again, what we see mostly is us just trying to go from statements like, we won't have any high risks. And I'm not picking on anybody. If somebody has that as a risk appetite statement, totally fine. You have something. But where we are is, a lot of what we see is people going from statements like that, trying to get them to actually look at a loss tolerance curve, right? So that's kind of the point we're at. So, just to sort of recap my babbling, yes, it would be nice to have multiple risk appetite statements per system or per department or business unit. The reality is that's hard to get to. So I wouldn't start out trying to get there. Just try to get something in place that is not, oh, we have, we'll get rid of all highs, all high risks. So that's a very good question, by the way. Love the question. There's the ideal, and then there's the reality.
Thanks, Randy. Lucas, any additional thoughts there before we move on?
Not many, no. The only thing I think I'd add is I agree. I think multiple would be the ideal, but then the only thing I'd caution with there is that you set them using the same methodology. Because I've seen organizations who have different risk tolerance or risk appetite statements set, and they're following very different methodologies or different, how they're approaching and setting those up. So I think getting to, like Randy said, in reality, a really good one is a good starting point. And then if there are going to be multiple, just making sure the organization's aligned on how you set those.
Great. Thanks, Lucas. Thanks, Matthew, for the question. Awesome. One last question in this risk tolerance section. Can setting a risk tolerance help with audits? And I'll start with you, Lucas.
Sure. Yeah, I think going back to kind of what Randy opened with the first question of, why should you care? Why should you have a risk tolerance? I think the simple answer to that question is just because your auditor, your examiner might ask about it. And if you have a good one set that you're using, that's, it meets the requirements, will make that part go smoother. Part two that I would add to that is, auditors, examiners, they're going to give you findings, right? And oftentimes it's implement this thing or make a risk-based decision or go do a risk assessment on it. We see that a lot, in the FIEC guidelines, it says risk assessment. I think Randy's actually counted once, like 100 times. It's dozens, if not hundreds of times in the FIEC guidelines. And so, it's everywhere. It's make a risk-based decision, do a risk assessment on it. With the new NCUA's ISE statements, there's a whole section, the Core Plus, that's all risk-based. So I think from that sense, having that risk tolerance, it makes it really easy to show your examiners you've considered specific controls and determined it doesn't make sense to implement them based on your risk tolerance, or maybe you did because it did make sense. So it gives you a lot of room to have those discussions with them. A quick story is I was working with a smaller credit union a while back, and they were going through their NCUA exam, and the examiner had left and presented them the report and said, hey, you need to encrypt your entire internal network. And for them, that would, one, cause a lot of operational issues, but two, cost a ton of money and resources to get all of that set up. And so, luckily in the finding, it said, okay, you need to, implement internal network encryption, or go make a, do a risk assessment on it and accept that risk if not. And so with a proper risk tolerance setup, we were able to look at those specific systems it would affect, plug in that control, what risk would look like with it and without it. And from a business perspective, it actually didn't make sense to implement that. Those systems were within their risk tolerance. That additional control costs so much money to implement that there's really a negative return on investment for the business compared to the risk. And so they were able to make that decision and show that evidence to their examiner that we assessed it, we looked at the risk, and were able to comfortably accept not implementing that. So that's another way that I think, one, it helps them go easier, as well as just have those better discussions with examiners.
Super cool. Randy, anything to add there?
I think Lucas knocked it out of the park as far as a response. I don't really have anything useful to add, so no. And in the interest of time, we could talk about risk all day long, but I don't think anybody wants that. So no, I think that was a great response.
Thanks, Randy. Yeah, and I love the saving money or not having to spend more money. That's a pretty powerful outcome for everyone. Very cool. Let's move on to our next section here, making risk-based decisions. Randy, I'll start with you. What does it mean to make a risk-based decision?
Sure, absolutely. So I would say that in simple terms, it means that you measure your risk, you compare it to your risk tolerance that we're talking about, and then you make decisions about your security controls to lower that risk to an acceptable level, or treat it in some way. So when you're going about making your decisions, should I put this control in place? Should I not? I think and again, I'm not picking on anybody, but as security people, we like controls. We like to have control. We like to be in control. We like to put things in place and have all these tools monitoring things, and it can be overkill. And so that risk-based decision, back to Lucas's point, is, do we really need this shiny new tool that this vendor has walked in and showed? Do we really need to encrypt everything on it? Probably not, depending on where the organization is. And so the essence of that risk-based decision is not using intuition, not listening to vendors. And I know we are a vendor, so I can say that. But really just methodically going about measuring the risk, comparing it to the loss tolerance curve, and making a logical, reasonable decision that is best for the organization and its members and customers.
Great. Lucas, anything to add there?
I think so. I think that covers it well.
Cool.
All in the interest of time.
Sure. Yeah, we got a bunch more questions to get here through. So let's move on. Lucas, why is it important to make risk-based decisions? Kind of, if you have any additional layer there, what's the why behind it?
Yeah, I think it really comes down to proactively measuring your risk and prioritizing all those different things you can implement. As Randy mentioned, there's so many tools out there. There's so many controls out there, that you can keep trying to improve and improve. And if you have unlimited time and money and resources, that's great. But I think the importance of making risk-based decisions is really about prioritizing those items. So after you've done your risk assessment, then taking a look at, okay, are we above our risk tolerance in a certain area? What control will bring us below that? And then once you know the options of controls, then you can weight them based on cost. There might be something easy, a quick tweak. You could turn on a setting on a tool you already have, implement, a process around reviews, whether it's manual reviews or automated. And so comparing the cost of those items with how much risk they're reducing, that's where you can get that return on investment and really start to prioritize based on reducing the most amount of risk for the least amount of cost. And I think that's one of the really big important things, because otherwise, again, you're seeing a shiny new tool here, trying to implement it, seeing a new one over here, trying to implement it. and you might have all these cool tools. Maybe they're not working together, maybe they are, but how much risk did you actually reduce? Because you're implementing all these tools and not properly managing them. You might actually be introducing more risk, which is kind of the irony of it. But so that's where I just think it really helps prioritize what to do next with your security program to kind of help set that roadmap by looking at risk first. And then the only other piece I'd add to that is oftentimes, we see organizations do a risk assessment and they're just reacting to audit findings. Which you have to be in compliance, right? That's a non, and no, you have to be, but they're reacting, they get an audit finding, so then they go put in a control. They get an audit finding and go put in a control. And so it's kind of this reactory based approach to managing their program rather than actually measuring their risk, seeing that whole picture and knowing, okay, what are my priorities based on risk, and getting really ahead of those items, and then being able to show an examiner that hey, here's why we implemented these controls. It was to reduce the most amount of risk. Here's what's next on our roadmap. Examiners will look at that and go, oh, great. I can maybe make a recommendation to follow up on some items on your roadmap next year, but they see that you're being proactive and assessing that risk and then prioritizing those controls to implement to reduce that risk program.
Very cool. Randy, anything to add there? And then I'm going to add also to finish up this section, kind of the why behind risk-based decisions, but any pitfalls for not making risk-based decisions. Randy, if you want to tie a bow on both of those for me, that'd be great.
Sure, absolutely. I'll see if I can remember both of those. Yeah, and I'd like to actually hone in briefly on one of the things Lucas was talking about. That is the why behind the risk-based decision. It's ultimately to know you're spending the right amount of money on security, right? We security people love to spend money. You give us a $10 budget, $1,000 budget, a $10 million budget, and we can spend it. But ultimately, it's about taking a step back and realizing that you, no matter how much money you spend, you can't get your risk to zero. The world just doesn't work like that. Even if all the manufacturers out there like Microsoft, not picking on Microsoft, but even if they started out with a security mindset, we still couldn't get our risk to zero because attackers are too sophisticated. They're too motivated. And so we don't want to spend $10,000 protecting a $100 asset, so to speak, right? So why the risk-based decision? Ultimately, if you think about it from a business perspective, it's to better serve members and customers and gain a competitive advantage, knowing that we're not taking money and throwing it out the door, at the latest shiny object and spending money in the wrong place. And as far as that kind of leads to your next question, the pitfalls of not making risk-based decisions. I think that when an organization does not make decisions based on risk, they can end up relying on intuition and chasing the latest tool, like we talked about. And I tend to call it the heyday of security, kind of the late 2000s maybe, where we collectively woke up and realized, oh, we need security. There's all of these attacks going on. They're getting smarter every day. We need this. We need a SIM. We need that. We need FireEye. We need all of these things. Just putting stuff in place. It was kind of free for all. And so, trying to put controls in place for everything leads to overspending, leads to burnout, leads to tool fatigue, and tools sitting on the dashboard. And so the pitfall, I think, in not making risk-based decisions, back to spending too much money, burning people out, and really, when it comes down to it, from a business perspective, not doing right by your customers and members, and not competing as well against those other institutions or companies that are out there.
Super cool. Thanks, Randy. And yeah, big takeaway before we move into the next sections for me are obviously aligning risk management with the business objectives and the organizational objectives, and really serving the organization, members of the credit union, your customers at your banks, et cetera. But then it's also almost like a third-party validation of whatever we're doing, right? That's unbiased, so just looking at data, looking at outcomes that can prove your initiatives, right? And I've heard this a lot from Reveal customers. It's like, hey, it's been able to provide more trust in our security program. We've gotten more trust. We'll talk about that in these other sections. And given making ultimately the security team look better because they're making the right investments and they can have data to back that up into the investments they make. So super cool. Awesome. We're good. We're about halfway through our agenda here. So we're going to move into quantifying risk. So first question, and Lucas, I'll throw this to you. Why does the board of directors pay closer attention to quantitative risk versus qualitative risk?
Yeah, I think you touched on it nicely too, and it goes back to building that trust with them is one, it's an understanding. Um, you know, qualitative risk, all the technical acronyms we have, it's kind of hard for them it's hard for them to understand. Back when we did qualitative risk assessments years and years ago, we present it to the board of directors or present it with our client to the board of directors and go, yep, here's the risk assessment. They'd kind of look at it, eyes would glaze over and next. It was a very, very short discussion. And I think it's because the board, they're generally not security people. There's usually one or two maybe on the board that are, but they're often business people and they know, they understand revenue and the organization's growth and the strategic and business objectives of the organization. And so when you can quantify it in financial values, it's easier for them to understand. It makes sense to them. You're speaking in their language. So I think that's one of the biggest advantages, and why the board pays closer attention. Because when we give them a report with financial values on it, they see a big number, and even if they don't understand why or what, they go, "What's that? What does that mean? Please explain that to me." They strive to then understand it because they want to know and make sure that if okay, now we're talking financial losses, what does that look like? How can how can we avoid those? Um, and so then kind of fast forward when we present a risk assessment to the board now, it kind of changes from, hey, currently we're at medium high risk. I want to go spend $50,000 to get us to low medium risk. That's hard to define or for them to understand. They go, what does that mean? So there isn't as much trust there as when you present to them and go, hey, currently our email system is at $500,000 worth of risk. I want to go spend $30,000 to reduce that risk by 150,000, and at a whatever that is, a few 100% ROI. That they understand, that they can approve and understand and go, yeah, that makes sense. We're spending all this, if we're going to spend this money on security, when they can see what they're getting back for that money spent, as far as risk reduced and money ultimately being saved for the organization, I think they pay a lot closer attention. They understand it, and kind of to your point, it really starts to build trust with them. They trust you as, that leader for the security team.
Thanks, Lucas. Randy, any additional thoughts there?
Yeah, just a little tidbit. Yeah, I think just understanding where the board is coming from. Lucas covered it really well. Depending on the type of financial institution you're at, you might be at a larger bank and your board is paid. They meet monthly for 8 hours, so they're really digging into stuff. Or you might be at a credit union and your board might meet quarterly for an hour or two. But in either case, that's not a tremendous amount of time. And if you think about all that they have to cover in those meetings, loans, ratios, debts, write-offs, the vast majority of it, at every financial institution I've ever talked to, it's mostly dollars and cents. So if you think about just from a brain capacity task switching perspective, they get into these meetings, whether it's monthly or quarterly or even yearly, and it's dollars and cents, dollars and cents, dollars and cents. And they get to security and it's high, medium, low. And they go, well, first of all, I don't understand security. I'm not a technology person. I'm a business person. Second, what is this high, medium, low stuff? It doesn't have any meaning, right? So back to Lucas's point. And so again, I just think putting it in terms that business people speak, the language of finance, it fits better into the meeting. And I think it also elevates security to something, where it used to be kind of this, small cost center kind of buried in IT. Talking about it in dollars and cents, I think in a lot of people's minds elevates it to kind of a C-level thing, something that's important for the organization, and it has more meaning.
Very cool. We do have a question from Matthew here. And once again, folks, if you have additional questions, please put them in the chat or the Q&A. We will try to get to them. So yeah, I'm going to read Matthew's question here. Let's think about the future. How will AI impact how risk managers perform their work in the risk assessment cycle, from identification to monitoring, etc.? Have you talked with ERM software vendors, and how will they use AI to enhance their software to enable someone to use software tools to help them manage the risk process, to include risk reports, graphics to show risk levels and environment, and integration with real-world impacts such as interest rates, inflation level, and other inputs that affect financial institutions? And then he goes on to clarify, the assumption is that ERM software is currently in existence, and how will AI improve ERM software? Any thoughts there from either of you?
There's a lot there.
Maybe we need to do another webinar on the topic.
Well, yeah, I think that line of questioning was an entire webinar. I took a couple notes and I'll try and tackle it.
Cool.
I would say that well, actually, how will AI impact risk assessment? That we did a webinar on that recently, so that is that piece right there is a webinar on its own. I will just say I'll speak about that in generalities, and then I'll do my best to hit the ARM piece, and then Lucas can jump in. I think that AI will impact risk assessment in the same way that it will a lot of things, where that intelligence piece, looking at a system, what it's made of, what kind of data are transmitted by it, stored and transmitted, the impact of the organization, what controls are in place, and really not only performing just the math behind it, but really understanding what's going on there. That intelligence required to look at something and identify a pattern and make good recommendations, right? So a lot of that is solved by the math that we use in our platform, which is not ERM, by the way. But just that intelligence required, it needs people, it needs intelligence, and there aren't enough security people out there, right? We've all heard about, the million or 3 million or whatever millions of open jobs there are. There isn't enough security talent. So I see AI fitting in, doing what it does well, and that is taking in large quantities of data, understanding patterns, making predictions, and spitting out recommendations, as an example, right? So we can I'm not painting a roadmap for anybody here, but we can take data, all of our clients, all of our risk assessments, feed that into an internal AI system, not one that's external, right, where they have our data. We can run that in there, write all that data to train the model, and spit out recommendations that our very smart humans, are likely to have recommended. And then it's a review at that point. So impacting risk assessment, I think machines can do a lot of that heavy lifting of the analysis. And we could talk about how it's going to impact risk individually, kind of at a tactical level, for hours upon hours. I won't do that to you guys. But to the second part of Matthew's question, ERM, we don't do ERM. Our software is cybersecurity management platform specifically. Having said that, I think AI can impact ERM as well. And I've talked so much that I don't remember the specifics of Matthew's question around ERM. So I'm going to just stop there.
Great. Lucas, do you have any additional thoughts to add before we move on with the question?
I don't think so. I think Randy covered it well, kind of from a general perspective, and I think AI will affect ERM software the same way, as far as making better recommendations, helping streamline the risk assessment process, parsing a lot of that data to make those enterprise risk assessments easier and better as well.
Awesome. Thanks, Lucas. And thank you, Matthew, for the question. Once again, reach out to us if we can have a more in-depth conversation. I guess we did ask for challenging questions, and Matthew's bringing it, so we appreciate it.
It was so challenging, I couldn't even answer it all.
I love it. I love it. Well, we do have time limited here, so maybe we can get into it more offline with you, Matthew, or anybody else has more additional follow-up questions. Happy to talk as well. So we got about 15 more minutes here, and I'm going to kind of go through a couple of these questions, highlight the ones we've covered a lot, but a couple of the ones that I want to make sure we cover are And Lucas, I'll start with you. What metrics and KPIs are commonly used to measure and quantify cybersecurity risk?
Yeah, it's a really good question, and we get asked about it a lot. The first piece I'd say is just measuring that risk in financial values. Starting there would be, when you quantify it in financial values. The next piece, some key metrics that I think are valuable are tracking one, average inherent and residual risk across the organization, tracking the number of systems that exceed risk tolerance. So, we started this webinar talking about setting that risk tolerance. Tracking how many systems exceed that over time, I think, is very important. The next piece, again, with historical tracking, that average residual risk over time, how that's changing. Is it going up? Is it going down? And ensuring you're managing that over time across the organization. And then the final piece I'll mention here is we also have specific KRIs, or key risk indicators, that we track risk against as well. And actually, we had a client recently who was doing something very similar, where they had a few different areas of their security program they'd report to their board, that were specific risk areas, and he was using as risk indicators. That was a single slide that was really nice for a board presentation. So we're actually building that chart specifically into our software, something we track on the back end, but didn't have any of the pretty graphics. But so areas like unauthorized application access, or disaster events, or network security, tracking your residual risk over time across those areas. And why that's important is it gives you a clear picture of some of the weakest links in your systems. So it will show, oh, maybe we have really high unauthorized application access risk. Why is that? Are we missing MFA on a lot of systems? Are we not doing user access reviews? Are privileged accounts not monitored? Those types of things. So there's unlimited metrics you can track. Those are some of the key ones I recommend, and some of the whys behind at least a couple of those.
Thanks, Lucas. Randy, any additional thoughts there before we move on?
Yeah, I would piggyback on that, and I would say just using KPIs for setting control implementation. And so from our perspective, what we do in our platform, we call it real-time risk, and that is pulling data from external tools or having users upload information into the platform, and we create metrics out of that information, compare it to a KPI, and then if the KPI is met or not met, then that can automatically set the status of the evidence and the control related to risk. So it's not just a once a year, oh, is this control in place or not? It's more of an ongoing automated process for updating the control status, which they do change over time, right? So a day after your risk assessment, it might be out of date. And so from our perspective, that real-time risk, setting up those automations to use those KPIs to set control implementation, I think is a huge win if somebody can get there and be looking at their risk periodically throughout the year rather than just once a year.
Thanks, Randy. That's great. We got about 4 or 5 more questions we're gonna try to address here in the next 10 minutes or so. And then if anybody else has any additional questions, feel free to submit them. Randy, I'll start with you. Where can quantifying risk help businesses beyond the realm of cybersecurity? We've touched on this a little bit, but any additional thoughts you'd like to throw out there?
Yeah, absolutely. I would say certainly, cybersecurity can touch everything. Obviously, we know that as security people. But in terms of budgeting, we talked a lot about spending the right amount of money. Well, some security people are in a position to need to, where they have to go and submit a budget, get a budget approved, pay attention to the budget, so that when you quantify risk, making recommendations, again, it helps with budgeting, the whole financial piece. We've talked a little bit about, obviously, it helps with compliance as well. So you're quantifying risk. When the examiner or the auditor comes in and sees that you're doing that and you're making solid business decisions based on your methodical quantification of risk, right? That certainly helps as well. Then we've also talked about cyber insurance. I'll tie that back in here. Just depending on the company, they may or may not dig into your risk assessment, but seeing that you have a process in place to measure risk, quantify it, to make decisions around your controls, it's going to give them a level of comfort and be more inclined to insure insure your organization, against the cyber breach. So I think probably in those areas, those are the ones that come to mind.
Thanks, Randy. And due to time, I'm gonna jump back and forth between you two doing a rapid fire to kind of finish up these questions. So, Lucas, I'd love you to take the next question. Why are uh, quantifiable risk assessments the future of measuring cybersecurity risk?
Yeah, great question. I think it's a lot of the things we've touched on kind of today already, as far as it's easier to make decisions based on them. You can take that proactive approach to your security program, really prioritize the resources that you have to reduce as much risk with the budget that you have. And just for understanding, building trust with that board of directors, understanding from other business units at the organization, and being part of the organization's strategic and business objectives going forward. I think are really why quantifying risk will be so important in the coming years.
Thanks, Lucas. Randy, I'll have you take the next one here, kind of talking about the ROI of your security program, determining it. How do you assess the tangible versus intangible benefits of security programs when calculating ROI?
Oh, gotcha. Yeah, very good question. I have to process that one for a second. I would say looking at the end state, right? So the risk reduction is the benefit, right? So the outcome of doing the risk assessment, building the security program, it's around the risk reduction, right? You're kind of like brakes on a car. I didn't come up with that, but I heard that probably 25 years ago, is that security is like brakes on a car, where it's not supposed to slow you down overall. It's supposed to speed you up because it slows you down at the right time or in the right way, right? Imagine driving a car without brakes. You wouldn't feel comfortable going more than about 5 miles an hour, right? Because if you're going 60, you're going to run into something. So in terms of the benefits of the security program, when you're calculating ROI, I think it's about arriving at a place where you can plug the risk reduced, whether it's per control or per system or overall, into the basic ROI formula, which is pretty basic, and that obviously requires a measurement of your controls in place. And so, ideally, if from a control implementation perspective, it's not compliance where it's in place or not in place. It's more of a maturity scale of zero or 1 to 5, and so just trying to assess those controls in that way, feed that information back into the risk assessment. Therefore, you can take that resulting number, plug it into the ROI formula, and again, back to what we've been talking about, speak the language of business in terms of dollars and cents, not how you.
Thanks, Randy. That's great. Lucas, I'm going to have you take this next question. How do you ensure accuracy in ROI calculations for security programs?
Yeah, so going back to actually something Randy just said, is really the ROI piece is easy. Once if you've accurately calculated the risk, that's the tricky part. But once it's accurately measured, okay, if you need to spend 20,000 on a new firewall or new control, how much risk that's going to reduce, and you arrive at your return on investment. Now, the accurately measuring the risk, that's where it's tricky, and obviously the ROI will mean nothing if the risk isn't accurately measured. And with all things, it's never going to be perfect. That's why there's ranges. And but one thing we use is we use Monte Carlo analysis, the statistical analysis in our software to measure that, as well as breach data. So that's kind of the back end to get as close as possible, right? Looking at, all right, historical breaches the year before, to take into account things is how much on average did it cost if there was a breach in different industries. Looking at things such as how often when there's a breach, is it because of phishing? Is it because of a vulnerability? To arrive at some different probabilities. But then really diving into each of your individual systems to arrive at those endpoints as far as how many users, what controls are in place, what types of databases and servers make up that system. So there's a lot of different inputs, right? And you could spend a year assessing a system trying to get it perfect, that perfect measurement, so there's always, it's never going to be exact. But we have a pretty, we've come up with a way using those different tools, different inputs to get a pretty darn close estimation of that risk, in a matter of 30 minutes per system. So it's doable by small teams. And so that's really the key piece as far as if you get the risk measurement accurate, then the ROI piece is easy, just comparing how much you want to spend in different areas to reduce more risk.
Thanks, Lucas. Randy, kind of the next question here, talking about increasing trust with the board of directors, and we've talked about that a bunch throughout this event, but is there anything else, any other ideas you have on what can security teams do to help strengthen relationships and trust with the board?
Sure. Yeah, absolutely. As you mentioned, we talked about quantifying risk. That is the big one, I think. And just speaking from real world experience, we've helped a lot of clients do just that with our quantified risk model. And shameless plug there for what we do, but it does change the conversation. The other thing, just aside from good cyber risk quantification model, is just changing up potentially what is reported. And so we, probably 3 or 4, maybe 5 years ago, it's been a while. In trying to help our clients report to their boards better, we actually created a template. It's free for use. I'm sure you could download it somewhere. We can get somebody the link if they want it. But what we were seeing a lot of the times, was very technical, very in the weeds information. That again, when we go back to when these boards meet, it might be monthly, it might be quarterly, it might be once a year, and they're not security people. So we're talking to them about, and I say we loosely. What we had seen in the past is that our clients would be talking to their board about number of spam messages blocked at the firewall, right? That's good for somebody to know, not the board. So reporting to the board on their level is going to further establish that trust. And this template, I started it. I took a step back and like, okay, I'm a business owner. If I'm a board of directors, what do I want to know about the security program? So at a higher level, the important things they need to know, not the minutia that we as security people need to dig into on a daily basis, just from a business perspective, from a decision-making perspective, what do they need to know to understand what's going on and to make those decisions, right? Just reporting the right information in the right way is going to help them trust you because you're giving them what they need to make their job possible, which is making decisions on the organization's behalf.
Very cool. Thanks for sharing. Yeah, I think about back to my previous comment earlier about understanding folks that are in other parts of the org. And a lesson I learned early in my career is that there was kind of a below the line buyers or decision makers, and there's above the line. Below the line are folks that are actually going to use the tool, that are in the weeds in your department, et cetera. Above the line are folks that are outside of your department, usually, that are either writing the check or making the financial decisions. Above the line cares about ROI. Below the line cares about how does it actually impact their job, right? And what things they need to change in their job. And so it reminded me of that.
Certainly.
Right on. We have about 2 more minutes left here. Lucas, I'd love for you to wrap up a question we actually got from the audience is, how do you transition a risk culture to accepting something as basic as risk assessment?
Yeah, that's a great question. The reason being, and we get it a lot, right, is a lot of times we see organizations that don't and work with people who don't have buy-in from the organization. Like Randy told a story at Albertsons, they weren't security minded. As far as they accepted all risk, they just didn't, security wasn't important to them. Risk and buying in wasn't important to them. So I think the first step is to help them understand. We talked a lot today about quantifying risk, getting that buy-in, building that trust by them understanding and how it impacts the organization. So I think one key area, just kind of tactical thing you can do, is having executives be part of setting that risk tolerance and doing it in financial values. So you can sit down with them, say, here's what I'm trying to do. Even that's just a great first step, even if it's 20, 30 minutes of asking them questions to determine how much financial loss they'd be willing to accept at the organization. I think it will start to build some of that trust as far as, oh, wow, they're really looking at this from a business perspective, and how cybersecurity ties into the business, and helps build the relationship with them as well. And then at that point, you also have them agreeing on what that threshold is. So if you go back and measure the risk and it exceeds that threshold or doesn't, that's when you can come back to them later and say, hey, we set this risk tolerance together. We were in agreement. currently I'm seeing we have certain systems or certain areas of the business that are exceeding that risk. So we need to make a decision about that. We need to accept that risk, or, I need some more budget to go mitigate this. Here are my thoughts. So I think that's a great first step as far as just getting their buy-in in the process, to just transition so they're viewing risk in the same way you are going forward.
Thanks, Lucas. I love that, getting their involvement and their participation in the process. That's awesome. Really cool. Well, we are out of time. We covered a ton in today's event. Thank you all for tuning in and giving us your attention. We will be sending out this recording after the fact. If you have any additional questions or follow-up questions, feel free to reach out to us. Happy to have a one-on-one discussion. Thanks again, Randy and Lucas, for letting me pepper you with questions and taking questions from the audience. Great discussion. Thanks again, everyone, and we'll see you all next month.
You guys.
Thanks, Adam.